G'day, Fred. How are you?
You good, mate? Yourself?
Yeah, not too bad. It's been a pretty uncertain time at the moment. How are you going?
Yeah, well, we're all in lockdown as the rest of the world, so hope everyone's managing to stay safe.
Yeah, it's a very uncertain times, but I suppose look, I've been listening to a bit of the macro boys about talking about how they see this unfolding, and whilst there is this degree of uncertainty, I think there's one commonality coming out of all of these discussions, and that is that trend following might have a very good next decade. It's been pretty tough for the last decade with all of this central bank intervention, but and this very low volatility environment. But I don't necessarily think that's going to be the same for the next decade. So we could have a bonanza coming up. So I'm looking forward to getting these strategies finished.
You're not in the market of predicting, are you? That's not a good thing.
No, exactly. No, we just follow price, no prediction.
That's it. Fingers crossed.
All right, mate. So look, I thought in this podcast, so this is for our members who are becoming familiar with the processes we've been taking with our trend trading strategies, and they'll be familiar already with the four different traders that we're looking at, one being the breakout trader, or we call it the bow trader, the other being a Donchian trader, which we call the Don, and the two others being moving average crossover traders, one the moving average with a take profit, and the other moving average with a trailing stop loss. So we've been, for the last few weeks, undertaking fairly comprehensive tests on these, and at the same time, Fred has been diligently working on modifications to these EAs to enhance their use. And we thought tonight we'd go over some of these enhancements that Fred has put in so that people that are using these EAs know these additional modifications that have been made and understand them and why we've decided to use them. So, look, I thought we'd start with looking at the four particular traders have... Each trader has got three separate EAs, one being the optimizer, one being an iterator, and one being the trader itself. So this particular version that I'll be releasing to our forum members on Wednesday, these are the particular EAs that will be released. So the bow trader, we're dealing with version 200408. For the Don trader release, we're looking also at version 200408. For the Mat P trader, this version is 200409, and for the Mat SL trader, it's 200409. These will be released to our forum members on Wednesday. So just to get into the background of these, we'll look at the optimizer for a start, and we'll look at the additional properties and features that have now been built into this EA. So we'll select breakout trader, BO optimizer, and we'll go into expert properties. So Fred, anytime you feel like stepping in, just step in over me, mate. With this particular trader, we are optimizing over these ticked options, both the Donchian period, the ATR period, the stop loss in ATR multiples, the take profit in ATR multiples, the break-even setting in ATR multiples, and this new feature, which is the trade direction. In relation to the static variables that aren't optimized, we test these on 0.5% trade risk, which means 0.5% of our trade equity is used for our position sizing for each of these particular scenarios.
Just to clarify something there, it's not actually 0.5% of the account balance, it's 0.5% of the available free margin. So depending on what trades are open at the time, that will influence the percentage calculation.
I see you, mate. So it's looking at both the closed trades as well as the unrealised trades at that particular time, the floating equity at that particular time?
It's the available free margin. So when a trade is placed on the platform, it actually takes up some of the margin that's available for future trades. So this percentage is against the available free margin. So people who have been trading live will have noticed that that margin goes up and down depending on where you are with your position and which trades are open at the time. It's just a minor difference. You probably wouldn't even know the difference, but just to clarify, it is available free margin.
Nice one, mate. Thanks for that. So 0.5% on available margin. Fred, do you want to talk about, well, one of the things is the test range where we're undertaking these tests on is a very long test range. We're now undertaking a range from between 1985 up to the 31st of the 3rd, 2020, basically last month. The reason we are incorporating such a large range for these particular models is that we want to ensure we include those very fat-tailed environments that include the 1987 crash, the 2002 dot-com bubble, and the ensuing crash, the 2008 GFC, and of course the most recent events that are unwinding with the COVID-19 impact. The reason we're doing that is that these particular models actually flourish in those uncertain regimes. So we want to therefore ensure that the data is the thing that's determining the outcomes here, as opposed to any assumptions that we might build into our strategy. So Fred and I have taken a stance that we'd like the data to tell us whether to be long, short, or both long and short, what Donchian period ranges are optimal in terms of their MAR relationship, those sort of things. So Fred, do you want to discuss that a bit more?
Yeah, and it's important to remember that this is what we're doing. Our members can do what they like in terms of the regime they're looking at and their variables that they want to use. But if you do find something interesting, it'd be nice if you could post it on the forum so we could share it with everyone else. But this particular regime is what we're trying to work our way through, and by keeping consistent, we're getting some results that we can compare against each other. But just the one variable here that hasn't been used before is the trade direction. You'll notice it's the last one on the list. The reason we've introduced this is it was fairly obvious that the indexes tended to trade in a long direction only, more often than not. And so we thought, well, let's see what happens if we have a trader that will actually only trade short or only trade long, or let it run in either direction. So by ticking that box and setting the starting position the way Richard's got there, where we start with -1, we go in steps of 1, and we stop when we get to a step of 1, we actually go through all three options. We start with a short only position, then we go to a both, and then we go to the long. And so what was really interesting was that while we introduced this to, again, let the data show us what was going on, particularly with the indexes, this actually has a fairly significant impact on the way these traders work on just about every index, any index, commodity, and forex pair, which was a bit of a surprise. But you'll see that as you start doing your own testing.
We'll actually run through an example tonight, Fred, that will demonstrate what you're talking about, so they'll be able to see it.
Okie doke.
In relation to the optimized ranges, so for this particular trader here, we're starting with a range of between 50 to 600 in terms of Donchian period with steps of 50. I won't go through each of these individual ranges here, as the forum members will be able to see it with the set files that I load into the forum itself. But it just shows you that not much has changed from the prior versions, apart from these additional features here. In relation to the Don trader, it's effectively the same story. We still have the classic DOM period, ATR period, etc. But we've also included trade direction with the DOM, and the same with the MAT-P and the MAT-SL. They operate off ranges, but we've included also, we'll go to the MAT-SL, for example. You'll see that the optimizer allows us to trade long, short, or both. And you've got all the specific ranges for the different variables used for that particular strategy. So that's yep, sorry, go ahead.
Sorry, Rich. The other thing you might want to just spend a couple of minutes on is talking about the percentage trade risk versus the fixed dollar trade risk, and why we've chosen to use a percentage figure there.
Yes, so when you run a fixed trade risk, what I'll do is I'll just bring up a visualization here, and I'll just bring up a visualization of an equity chart that is using a fixed dollar risk per trade. So what happens when you apply a fixed dollar risk per trade is that you start with your initial deposit, and your equity curve progressively builds. And your percentage drawdown with a fixed risk on that equity curve dilutes over time as your equity builds, but your drawdown doesn't build in the same fashion. So what you tend to find with fixed trade risk applications is that the drawdowns usually, in percentage terms, I'll refer to this in percentage terms, the drawdown. In percentage terms, the drawdowns, we saw that the dollar drawdowns was actually largest towards the end of the series, but on a percent trade risk level, it pushes the drawdowns towards the front of the series. Now, this is because we are not treating a drawdown in percentage terms equivalently over the entire series. That's why we optimize and test with a percent drawdown or a percent trade risk. By applying a fixed percent trade risk, the relationship between the drawdown and the equity curve in terms of its percentage relationship stays more constant than a fixed trade risk. I hope I've explained that enough, Fred. Maybe you can explain it better than that.
Yeah, no, I think you covered that. But the trade-off also is, where it's also seen to be relevant, is when you're doing your MAR calculation, because the MAR calculation is looking at the drawdown percentage over the whole range of the equity curve, and by using a percentage risk, we get a more representative portfolio or picture of what's happening with the drawdown to equity, and therefore we get a MAR that's more realistic. And so when we're sorting and iterating across MAR, we felt that the percentage risk was the better way to go.
Yes, and what you'll find, if you can imagine these two lines, I'll just highlight the two lines to look at. This first row that I'm highlighting here shows this portfolio run with a fixed dollar risk of $500 per trade. This next line shows a percent trade risk result, which is our preferred method. When you look at this ratio here, which is called the CalMAR ratio, I'll just bring that up there, the CalMAR ratio, you'll see that when dealing with a fixed risk, it looks like the CalMAR ratio, and the CalMAR ratio is very much like the MAR ratio. It's looking at the compound annual growth rate over the maximum drawdown. So the compound annual growth rate here was 9.5% per annum, and the max drawdown was 3.78. We had a very high CalMAR ratio here, or a high MAR ratio here with a fixed risk. Now that's a bit deceptive. The percent trade risk gets us a more realistic relationship in terms of MAR. See how the MAR has dropped, or the CalMAR has dropped to 1.14. The CAGR is 16.2 because we've got a percent trade risk, which naturally therefore compounds over the course of its cycle. So yes, that is higher than the fixed trade risk version, but the drawdown is also commensurately higher, and it deals with that issue that we said regarding it's more representative of your actual drawdown you will incur, and it's higher than what your fixed trade risk will do. That therefore produces a lower MAR ratio. So we prefer to use percent trade risk in our optimization and iteration approach. But what is very important here is to look at, I'll just show you the dollar terms in terms of drawdown. Won't be a sec. I thought I had it here. I might need to add this. Won't be a sec for it. Drawdown in dollars. Okay. Now, what is important is to see the total drawdown in dollars. So at the moment, when you're looking at the compound annual growth rate and the maximum drawdown, we're looking at a relationship between these two columns here. But always keep in the back of your mind that your maximum dollar risk exposure is reflected by the actual dollars of drawdown. So with a $100,000 initial deposit with this particular portfolio here, it says that our maximum drawdown was 3.78% in terms of our equity. However, the real drawdown in maximum dollars was 49,000. Now, what this tells you, therefore, is that even with a fixed dollar risk assignment to this particular portfolio, you can have on your initial deposit an absolute drawdown of close to 50%, even though it's deceptive and it looks as though the drawdown is not very large here. I'll just go to the dollar terms here. So that is the fixed trade risk equity curve that looks very smooth. You can't really see many drawdowns here, but the dollar drawdown, you can see, reaches a maximum here of 49,000, which is actually about 50% on your initial deposit. And because this is a fixed trade risk, this means that in this particular regime or market environment here, we did have a literal almost 50% drawdown. So I just thought it was important to look at the concepts of absolute drawdown, relative drawdown, MAR ratio, CalMAR. What do you think, Fred?
Yeah, that could come across as a little confusing. So if there's anyone's got any questions on that, please post them up and Richard will spell it out in more detail. But for the moment, just understand that we're using percentage risk on our traders.
Perfect. So I'll go back to where we were. So what I thought we'd do now, Fred, is just run a quick run with USD JPY using the Bow Trader to look at the output files that are generated from this optimization and iteration run with these new versions of EAs that you've produced.
But so you just need to explain that you've already run this process all the way through, so we've actually already come up with an optimum trader.
Yes. So I've run the optimization process, I've run the iteration process, and this particular USD JPY test has been already undertaken. So that's therefore generated the strategies to apply for this purpose of testing using the trader. So I'll just now go in and we'll be using this on a 0.5% trade risk value here, and I'll just put in the password and we'll get it running. So we're ready to go. I'll put the equity curve up. So this is USD JPY. Fred, feel free to chat as we go along here. Just to explain the strategies that are actually activating, I'll slow things down a bit. I'll go to this file here. So to explain this particular EA that is running now comprises all of these different individual strategies. So in total, there are 17 separate variations to this strategy running. We've got, these are the particular Donchian periods that are being applied, ATR periods applied, stop loss multipliers applied, take profit multipliers applied, etc. Now, trade direction, notice this new feature that we've got here. The outcome of this particular optimization and iteration generated 2 versions which were short only, 3 versions which were both long and short, but 12 versions that were long only.
And that was a surprise we found. We didn't expect to see that. But what that's saying is that the long only traders on this particular set of parameters actually delivered a better outcome in terms of MAR.
Yeah. So I'll just let this run, and so as you can imagine, we've therefore got these 17 different EAs all running, and this is how they're all blending together as a sub portfolio for USD JPY. You do get drawdown periods, as to be expected. You note that the floating equity sits above the realised balance, which shows that we have positive skew in our strategies, which is preferable to warehousing risk. But there are points in time we do get risk exposure. Here, this is an example here. But by and large, most of the time, we're sitting in this realm of positive skew. Let's try and speed things up a bit.
Yeah, so even though we've got a trader that's predominantly a long trader only, we are still taking a whole bunch of short positions, as you'll see as the thing moves its way through. Well, here, for example, we've got a lot of shorts going on.
Yeah. Yeah, there's some nice shorts, quite a bundle of shorts there. Well, we might see, I think this one has a very nice surge, a long surge, where we see a lot of those long trades all firing off.
Why don't you bring up the performance file, Rich, while this is going, so we can just see the outcome, because we don't need to see this.
Okay. So I'll stop this?
Well, let it keep running, but bring up the performance file over the top.
Just coming up now. Here we go. So these are the 17 discrete variations. These are the magic numbers, the 17 discrete variations. And this is the result of the entire sub-portfolio itself. So looking at the information that's presented here with that direction column, once again, -1 means short only, 0 means both short and long, 1 means long only.
In that last line, Rich, the 0 doesn't mean anything. It just means it's,
that one there.
It's not accounted. And similarly in columns W through to AA, that 0 just means it's part of the combination, part of the combo.
Beautiful, mate. An additional feature, we've just got an estimate of minimum free margin in here, which relates to available margin. Not necessarily that important, as we'll discuss this down the track, but it's just a nice additional feature to have. Anything you'd like to talk about in here, Fred?
No, not particularly, but you can see that the individual traders have got relatively small MAR, if you like, but in combo they're coming up with a value which is not too bad at all.
Yeah, so that's the individual MAR that Fred's talking about. Nothing here stunning, but when it combines into a portfolio, we certainly get a pretty good result when they all combine together. What else? Skew. You'll note that all of these versions have very strong positive skew, which is a good sign. There we go. So I'll just see if I can find where we had. So this is when we get these long trends, you can see how many of these long trades are activated, and that's because we've effectively in this version here, when we look at, we have got, these are short only, but these are long and short. So we have got 15 long trades potentially out of this scenario. And you can see a large number of them are firing as we get this nice long trend here.
What's the report look like on this one? Yeah, so
okay.
what did we make there? 2.2 million. It's not too bad.
Mate, very nice. I'm happy with that. This is over a very long time frame, 1985 to current date. It's a pretty good profit factor. Happy with that. The average profit trade was 10,000 now, and the average loss trade was 3,600. Now remember, because we're using a percent trade risk calculation here, it compounds the result over the course of time. So that accentuates the exponentially grows your equity curve, provided you have this positive expectancy over the course of the duration of the time series. That's why average profit trade is sitting at 10,000 with an average loss trade of 3,600. Shows positive skew. The trade wins. We can see that in terms of, just seeing here, short positions won only 26%, longs positions won 42%. So you can see that this particular trader certainly was biased towards long trades for this particular market over this particular very long-term time horizon. The relative drawdown here, 27% to achieve that level of total net profit. So Fred, anything else you wanted to talk about here at all?
No, I think that's all pretty clear.
All right, so look, I'll be releasing these new EAs on Wednesday, and yeah, so everybody, we hope you stay safe. Remember, there is no sense of urgency to get into the market during these volatile times. This particular approach we're using, this trend trading approach, is valid at any time. So there is no rush to take advantage of any condition now. Those conditions will potentially be at any time and any place. So don't feel a sense of urgency that you must start trading now. They have. So take care, everyone. And mate, thanks, Fred. And yeah, see you guys later.
Yeah, catch you all. Cheers.
Bye.